life insurance MEC. Is that some kind of mechanical monster wreaking havoc over Tokyo? No, MEC is an important acronym, but it can have serious tax implications. What it is and what it stands for is what you'll learn about in this video. And be sure to stick around for the best resource, my humble opinion, on how to avoid those tax implications and benefit from the tax advantages MEC avoidance has to offer. And if building tax-free wealth while paying off all your debt with the same dollars at the same time with your current monthly cash flow sounds interesting, then you need to subscribe to our channel and hit the bell. You'll be notified when we publish more videos on how you can end up with more money with the money you're making right now. Hi, I'm Tony Manganello, best-selling personal finance author. Since 1995, my business partner, John Commuta, and I have taught over 3 million people how to accumulate real wealth with their current income. Now, accumulating wealth on your current income might seem just a little impossible to you right now, kind of like it did to the 3 million other people at first, but it is possible if you know how the numbers work. And taxes play a big part on how those numbers work. And when it comes to life insurance and the MEC rules you'll learn about in this video, taxes are what it's all about. And there are 3 things you need to know so that tax man doesn't come a-knocking. The first thing you need to know is what MEC means. As I said before, MEC is an acronym that stands for Modified Endowment Contract. A Modified Endowment Contract is a life insurance contract that's not compliant with IRS regulations. And you know what happens when you violate IRS regulations. Now, there are 3 regulations that, when violated, can result in a MEC. They are TEFRA, the Tax Equity and Fiscal Responsibility Act of 1982, DEFRA, the Deficit Reduction Act of 1984, and TAMRA, the Technical and Miscellaneous Revenue Act of 1988. What these acts do is place limitations on how fast the cash value inside a life insurance contract can grow and continue to enjoy all the tax advantages life insurance contracts offer. Before the early 80s, rich folks were tax sheltering large sums of money inside of insurance contracts because of the awesome tax advantages. Rich folks would ask their financial advisors, they say, "Hey, I need somewhere to tax shelter all this money." Some advisors would say, "I know you're rich and you don't need life insurance, but if we create a life insurance contract with a teeny tiny small death benefit and stuff all your extra money in the cash value of the policy, it can grow tax-free, and there are ways to get at it tax-free." Rich folks would say, "Great, let's do it." And when the IRS sniffed this out, that's when they came up with the 3 acts and put limits and constraints on how fast cash value in a life insurance contract can grow. When a life insurance contract violates one of these acts, it's no longer deemed a life insurance contract, but a modified endowment contract. And what that means is that all the tax advantages the life insurance contract enjoyed are revoked, and the money inside the cash value is now subject to certain taxes that were otherwise avoided when the same contract was considered by the IRS a life insurance contract. These regulations are often referred to as MEC rules, rules that must be followed in order for your life insurance contract to remain a life insurance contract and continue to enjoy those awesome tax advantages. Now, if you like saving money on taxes, give me a "you know it" in the comments. The second thing you need to know is why the tax-free environment enjoyed by life insurance contracts can be so important. Tax-free growth means your money grows faster and is worth more. For example, if you make deposits of $300 a month into an account earning 5% interest in a taxable environment for 20 years, and you have to pay, say, 20% tax on the growth of those funds, at the end of the 20 years, you would have $110,032.39. Now, if you place that same $300 a month into an account earning the same 5%, but in a tax-free environment, you would wind up with $123,310.10. The same money, the same rate of return, but $13,277.71 more. But it doesn't stop there. If at the end of those 20 years you stop making deposits and you want to take the 5% from that account to supplement your income, here's what those numbers would look like. 5% of the $110,032.39 equals $5,501.62. However, since this is a taxable environment and that same 20% tax is in place, you would owe $1,100.32 in taxes, leaving you with $4,401.30. Now let's see how that compares with the tax-free environment. In that environment, we had $123,310.10. 5% of that amount is $6,165.51. Now, since this is a tax-free environment, you get to keep the full $6,165.51. So let's recap that real quick. You started with the same $300 a month, the same 5% return, the same time frame, but you wound up with $1,764.21 more to supplement your income because of the tax-free environment. See how important that is? A MEC is a taxable environment. A life insurance contract is a tax-free environment. This is why understanding what a MEC is and remaining compliant with IRS regulations is so important. The third thing you need to know is that there are times when a life insurance policy that is a MEC actually makes sense. Now, let's say you had a financial windfall and you came into some cash and you had 50 grand you wanted to stash away for your future. I know it's unlikely, right? But play along. You never know. You'd want to know where you could put that 50 grand where it would be safe. This is referred to as capital preservation, where it could get a good rate of return and grow tax-free, and where it could make the biggest difference for you and your loved ones. Common options for a sum of money like this would be places like a bank CD or a mutual fund. Now, a CD is fairly safe, but the rates of return could be pretty low. You can put it into a mutual fund, but most mutual funds come with something called a load, which is a fee, and these are assessed in different ways. The most common is a front load, and that can range from 3.75 to 5.75%. That means if you put that 50 grand into a mutual fund that had, say, a front-end load of 4%, you would be charged $2,000 for buying that mutual fund, and only 48 grand would be used to purchase shares in that fund. Additionally, the fluctuations in the market could threaten the safety of your money. In 2008, some people experienced the loss of up to 50% of their money in mutual funds because of the crash. If you put that same 50 grand into a MEC life insurance contract, let's take a look at what would happen. Properly structured, this is what a MEC would look like for a 45-year-old male. In the first year, your net cash value would be $48,299. So this is further ahead than that 4% load you would have paid for that mutual fund. But unlike the mutual fund where you're charged a fee for what could be considered nothing in return, with a MEC, which is a life insurance contract, with a cash value that's growing really fast, you now have a death benefit. In this example, the death benefit is $157,864. Contrast that to the other options. If you spend the cash and there's nothing left for your loved ones. With a MEC, you can spend almost all the cash and still leave behind a significant amount of money for those you love after you're gone. If you kick the bucket before you spend all that money and it's in a CD or a mutual fund, guess who pays your heirs a call before they get any of that cash that's left over? That's right, the tax man. On top of everything else your loved ones are dealing with during such a difficult time, they're also going to have to deal with a complicated set of tax rules. Contrast that with a MEC. Your cash value and death benefit continue to grow at rates faster than any bank CD, and your funds are protected from market fluctuations and corrections that mutual funds are subject to. And the funds in the MEC grow tax-free, and that may not be the case with a CD or a mutual fund. And when you kick the bucket, the tax man won't be paying your loved ones a visit. Now, if you'd like more information about life insurance MECs and how they work and how complying with MEC rules can help you pay off all of your debt and build tax-free wealth with the same dollars at the same time, click the link below and get your hands on a copy of the ebook, The Banker's Secret to Permanent Family Wealth, written by my business partner, John Commuta. And if you like this video, do me a favor and click the like button. And while you're at it, subscribe to our channel. I post new videos on personal finance every Thursday. we're here to help you end up with more money. I'd also love to know if you have any questions about the info in this video or on any personal finance topic. So please leave your question in the comments. I'll respond as soon as I can. You are the reason I'm here, and I make time every week to review your comments. Thanks for watching, and I'll see you next time.